Joining us, Sam Stovall is the Chief Investment Strategist, CFRA. So, Sam, I mean, is this as easy as a market as we're painting it? Just close your eyes, buy the top 7 companies again, and maybe a smattering of other AI plays, and just hold on for the ride? Because it doesn't seem like much else is working.
Well, you're right, Oliver. And what's interesting is that in election years, going back to 1992, the top 3 sectors in the first half went on to outperform the market in the second half about 90% of the time. So you're better off just letting your winners ride.
Sam, yesterday it seemed like when inflation came in real light that maybe this rally would broaden out. We've had fits and starts of it, but it always seems to hit a wall. Do we blame that on Jerome Powell yesterday, or do we blame it on the jobless data today that seemingly prevents some of the more cyclical industries from really celebrating?
I think you blame it on Fed Chair Powell because investor ebullience was dashed by the dots, is what I'm saying. That essentially, investors thought, oh, here we go, we're off to the races. You had the Dow, the S&P, the NASDAQ, the Russell, all up by 1% or more in anticipation that maybe we will see the cut in September, maybe even in July. But then that was certainly dashed by the Fed minute notes, as well as the Q&A during the press conference. And then today, because the initial claims popped up, or was not what markets had been expecting, then, yeah, that's a bit of a concern as well.
Okay, so Powell maybe a little bit of a letdown, but I mean, it seems like they're also trying to be realistic with what they're telling us, which is that they need to see progress to the actual target. I mean, it seems like the market too keeps getting a little bit too hopeful that they're going to suddenly change their target if things slow down a little bit.
Sure. Well, the Fed doesn't want to overpromise or overreact, and that's what they did in the 1970s. And the people certainly are students enough of the market, of the economy back then to know what had happened. So they want to make sure that they avoid those mistakes. So they're reminding us that they are data dependent, that one CPI print doesn't necessarily imply that they should back up the truck, but rather that they're going to continue to monitor things. Certainly, they saw today's PPI. And then the question is, are we going to continue to see a downward trend in PCE? But just as we were under the impression that they might ease a little earlier, now they're sort of slower to lower interest rates. They again could decide, well, maybe September really is back on the table, as the CME futures seem to indicate.
Sam, looking at your guys' allocation model, 45% U.S. stocks, 15% foreign, 35% in bonds, 5% in cash. That foreign to U.S., I'm particularly curious about how that kind of shapes up compared to other periods, because the dollar looks like it's not going to break, but the foreign stocks so far this year have been okay with the firm dollar.
Yes, they have. I would say this is more of a neutral allocation at this point. The S&P 500 is trading at a 30% premium to its long-term average PE. But when you look at the mid and small caps, they're trading at 25 and 35% discounts to their long-term relative PE. Also, the international markets are very attractive based on relative PEs. But what we need is the trigger. I like to say that fundamentals tell you what, but technicals tell you when and how far. And right now, the technicals are not saying that now is the time to be pulling the trigger, or at least overloading or overweighting on those areas that had been depressed for a while.
Okay, so let's talk about the what and the earnings as we close out this season. We start looking forward. Does it look like there will be growth sufficient to kind of normalize some of the valuation pickup we've seen? Because in the last, call it, month or so, the valuation moves have been much more substantial than in the previous couple months. Now that NVIDIA's growth has kind of peaked out, it's been a lot more valuation driven from what I can see.
Right. Well, prices lead fundamentals. So many times when we see price advances that are not necessarily supported by changes in earnings estimates right now, tend to be supportive later on. Right now, we're expecting about a 9.5% gain in earnings this year, 14.4%, as you can see at the bottom right of the table being shown for 2025. But these numbers are higher than what had been expected just at the beginning of the Q1 earnings reporting period. For the first quarter, expectations were for 3% growth. We ended up with 5.5. For all of 24, it was 9%, now 9.5. And for 2025, it was 13.7. So we are seeing upward revisions, which I think is what we certainly need. And again, this is now what, the 48th quarter out of the last 50 in which actual results exceeded end of quarter estimates. So management continues to do a very good job of managing expectations.
Okay. Good bit of red on here, but seemingly the more cyclical groups. So I guess we should be avoiding those until either cuts or recovery manifest themselves, or do you take the longer term look and say eventually those things will happen, buy and hold, be patient?
Well, I think that if you are a longer term investor, then yes, you do want to be patient. I do believe that we are due for another decline of 5% or more within this calendar year. The first quarter was the top 15. It was number 11, top 15 quarters since World War II. And 14 of those 15 had 5% declines or more, averaging about 11%. What's interesting, though, is that those declines that were less than 10% were followed up by another decline in excess of 5%, averaging 12.5%. The good news is, however, that every one of those years, meaning all 15 years, had positive full year returns, with the average being above 20.5.
Okay. So for those historical norms to come true, what do we need to avoid? Election chaos, concentration risk. Hope NVIDIA doesn't turn around because, like, you live by the sword, die by it. So far it's been lovely for the passive investor, but that's a tough transition without a big economic liftoff if NVIDIA starts going down.
That's true. Well, AI has been driving tech, and semiconductors, EI, earnings and inflation, have been driving the rest of the market. So it's really when we start to see the 10-year yield go the way we don't want it to be going, that tends to put the fear into investors. I also think that geopolitical activities could end up being a spark. But I would tend to say that meaningful declines, meaning more than 5% declines in the market, are likely to represent good buying opportunities because of some of the indicators I just mentioned. Also, a reminder that every election year since World War II that started with a positive January was higher for the full year, with the average gain being 15.5%.
Wow. Okay. Hey, can you clarify? You're the market historian, Sam. June is typically a pretty bad month, right?
It's a ho-hum month, but July is actually a pretty good month.
Okay.
The months you want to worry about are August, September, in terms of price changes, but volatility in October.
Understood. Great to have you here as always, Mr. Stovall. Appreciate your analysis. Thank you, Sam.
Thanks.
Chief Investment Strategist at CFRA.